All right, everybody. Hey, welcome to this episode of the Note Nation Top 40 Market as we roll into the Birmingham, Alabama market. Excited to have you guys join us this evening. Thank you for taking time out of your busy schedule. I promise to have you out of here in just under an hour for you guys out there. But we have a variety of local and national investors join us from across the country to find out more about what's going on in Birmingham. You can always find out the full lineup of our Note Nation Top 40, the top 40 cities as we roll into the final 20% of the market by going to notenationtop40.com to check out the replays and the remaining cities that will be hitting along the way. We'll be discussing the statistics and the numbers of what's going on in the Birmingham market and Alabama as well. We'll also talk about the future opportunities, where to look for those deals, and how to get started. So encourage you guys to ask questions, whether you're watching this live, join us in here on Zoom, or join us live on Facebook, or catch the replays across our social media networks as well for you. Ask questions. We love to hear feedback, and I want to make sure we get all your questions answered for you guys tonight. But anyway, for those that don't know me, my name is Scott Carson, everybody. I've been an active real estate investor since 2002. I'm the CEO of WeCloseNotes.com, and I've purchased over $500 million in distressed debt out there over the last, almost 12 years now. I've been working with real estate investors and teaching them how to tap into distressed assets since 2004. I'm the host of the very popular podcast, The Note Closer Show, that you can listen to anywhere that you download podcasts out there. And I invest all across the country, over 30 different markets right now we're invested in. And even though I call Austin, Texas home, I do invest quite a bit across the country, including the Birmingham and Alabama markets out there. So very familiar with those areas out there. Go Roll Tide, right? Or go Dragons if you're in Birmingham for you. But anyway, more importantly, let's start. Our mission here for what we want to accomplish with We Close Notes has always been to help investors to accomplish their goals and dreams, increase their wealth through debt investing. That's what we do. You know, that's why I'm called the Note Guy. I've been helping investors find great deals in the distressed debt markets for over a dozen years now. And why am I doing this? Well, I love helping people, investors primarily. I love helping people and investors to find deals, find opportunities when they often are stuck. I'm a big believer in I can solve problems. I'm a problem solver. I guess you could look at that as my love language in trying to fix things. I do believe that what's going on right now in the country with the distressed market is a huge opportunity for real estate investors if you know where to look and know how to take action, know what to do. Just like it was a dozen years ago, there's a huge amount of wealth that's going to be transferred in the next 24 to 36 months. The question I ask you is, how much of that do you want that to be yours? I also am doing this because I was once a distressed borrower. And looking back to 2002, 2003, when I was a distressed borrower, I am very empathetic with those that are struggling, facing foreclosure, can't pay their mortgage, behind their rents. I've been there, done that, got the t-shirt and the scars to show for it. And luckily for me, I came out of it. And because I had some great people helping me out with it. So I'm here to help educate you guys in the different opportunities that are available to you to do some good. Now, we all know that there's nothing greater than helping someone overcome an obstacle or achieve a goal or dream that they once thought was impossible. Many borrowers out there once thought the dream of homeownership was impossible. They've accomplished that, but now it's turned into a nightmare with being laid off, business closing, and everything going on with the pandemic. So I encourage you guys to be empathetic when you're thinking about what's going on with the borrowers. And we've had a big goal for ourselves over the next 12 months to really help a lot of people out there. And you could be a part of that if you're interested. We want to help over 1,000 investors tap into the debt markets here in the next 12 months, because we believe if you start making connections now, start putting these things in place, even if you're brand new to real estate, you can do a lot of good, not only for yourself, but your family, the borrowers, and the banks out there and people are facing issues. So where are the opportunities, ladies and gentlemen? Well, the opportunities, as I say, are everywhere, okay? Literally everywhere if you know where to look. And I don't care if you're looking at self-storage, you're looking for single-family homes, apartments, whatever it might be, even mobile home parks, office space, or even hotels, motels. There are a lot of opportunities out there. And the beautiful thing about the opportunities talking about right now, the banks don't care what your credit score is. They don't care what color skin you are, whether you're minority, whether you're white, whether you're Hispanic, Asian. It does not matter how old you are, color of your skin, instead of sex. It does not matter if you've been a successful business owner or struggled. If you're even facing forbearance, you can't pay your existing mortgage right now. I know that's scary, but the opportunities exist everywhere, no matter what your long-term or short-term goals are. And for you, maybe some of your short-term goals is I got to make some money to survive. I get that. But many of us have longer-term goals too that we all want to accomplish. And like I said, whatever your goal might be, it's important. It is important that you have a goal, whether it is to retire on the beach, drinking pina coladas, sitting, soaking your toes in the sand. That's a beautiful, beautiful goal. Maybe it's to, spend more time with your spouse, to retire him or her, so you guys can have more fun as a couple. Maybe it's to put your kids through college. Maybe it's to take your parents, say, Mom and Dad, thank you for supporting me. Now you take it easy. Maybe it's to travel more once we get out to start travel more. Maybe it's just to upgrade your digs, your properties, to find some more real estate, upgrade your situation. I don't care whatever it is. It's all great to have. But we know one thing, that it takes money for all this to happen. And most people, when they hear that or see that, that's when they give up on their dreams or goals. And I'm here to tell you tonight, you don't have to give up your goals and dreams. You don't have to stop because you don't have capital. The things that we're going to talk about tonight, yes, it takes money to do that. But the ways that we're going to be talking about doing things are great ways for you to build cash flow using other people's money and making some great things happen out there. So encourage you guys to definitely take part in what we're talking about tonight and get rocking and rolling for you, okay? What do the national numbers say, ladies and gentlemen? Well, they say some things out there that can be kind of difficult to take a look at. We are at 11.1% unemployment rate through June. July's numbers aren't out yet, but we expect that number to probably be about the same. Higher and lower, peaking in valleys in different areas across the country, but roughly about the same. As of today, 50 million people have filed unemployment right now. Ouch. You look at, we expect 52% of small businesses are expected to fail. That's not a surprise when you look at the number of unemployment. It's people going out of business, companies filing bankruptcy, closing their doors. It's going to be a rough time for a lot of people out there. Now, that leads us to keep in mind something here, everybody, is that before all this happened, America was already starting to struggle. 1 out of 10 borrowers were already behind at least 30 days in a mortgage before all this kicked in. You also talk about that the national mortgage delinquency rates were at 7.76. That's 1 out of 12 borrowers was at least 90 days behind their mortgage already. That's correct. 1 out of 12 was already 90 days in default on their mortgage before they started. Currently, there are 4.1 million Americans currently in default on their mortgages. When you look at history in 2008, 9, and 10, it took us 18 months to hit that mark of 1.6 million defaults. We are 2.5 times that in 3 times faster. Okay, everybody? Yes, things are going to get worse than before they get better. And not a lot of people are talking about what's going on in the markets right now. They're all worried about sickness and illness. And look, if you're not prepared, you can get left out in the cold. But also, if you are prepared, there's a lot of opportunity available for us to step in and do some good. Lenders are bracing for us to see 15 million mortgage defaults like we did 10 years ago. I don't know if we'll hit 15 million with what they're doing. A lot of the government loans are kicking the can down the road, giving 6-month forbearance agreements, expecting to give another 6 months and go from there. But at some point, the piper's got to get paid, as we all know. Somebody's got to pay the piper. The banks aren't just going to allow people to stay in their houses, mortgage-free or rent-free forever. So at some point, people got to get paid as we get rock and rolling. Now, if you look at a couple things, specifically in Alabama, every state has a housing hardship index. This is put on by Bank Rate. They take a look at the unemployment rates, they take a look at the default rates, and rank each state. Now, Alabama ranks is not the worst. Unemployment rate across the board is 7.5%, which is actually better than the national average. Kudos to you, Alabama. But the delinquency rate is higher, about 3/4 of a point, actually over a full point, so 8.77% across the board. So if you take those numbers together, Alabama ranks number 27 nationally, just past the halfway point. Not the worst, not the best, right smack dab almost in the middle there for everybody. Okay? I mean, it's going to vary on a city-by-city basis, as I think we all know. Okay? Now, if you're looking at the unemployment rates here for Alabama as of through June was 7.5%. That's down from a peak across the state at 13.8%. So it's come halfway. Now, comparing it to where it was in January, it was 2.7. So you're still 3 times worse than it was in January. Looking at Birmingham and the Hoover, Alabama market, right at the same numbers. 7.5% for June is where Birmingham is at for June. Peaked at 11.9% in April. So it's great. You had a little bit higher rate than the rest of Alabama in January, but you actually had less at the peak in April, and you're still on the same and par with where Alabama's at. And if you're looking at the rest of Alabama, the major cities in Alabama, And over on the right-hand side over here, I've highlighted all the cities, the major ones, so you can see the unemployment rates. So Birmingham, you can see our middle there. This is, I'm sorry, yeah, 11.6. And you can see a lot of the other things, the numbers popping up in there as well. So sorry about that. Now looking at the foreclosure market, because people, if they're unemployed, they're not paying their mortgage, and you have increase in foreclosures. Now Birmingham is not as bad as some other areas out there. Birmingham has 1 in every 3,500 homes is facing foreclosure, with the worst zip codes being 1 in every 1,700 and 35206, and then 1 for every basically just under 1,800 and 35208 zip code. And you can see it's basically, you know, the north side of the Birmingham has the rougher aspect of it. The middle doesn't have that much. So it's kind of a difference between the haves and the have-nots for you. All right. Now looking at, you can see an uptick in numbers month over month, year over year as well. They are up over last month, down previous year. And the bank owns is down across the board. That's no surprise. You can see how it kind of checks that the auction, the bank owned stuff. You don't see a lot of the pre-foreclosures on there, which is usually a blue line like you would with a lot of other places out there. So you can see everything dropped off the board in April and then started to spike back up with bank owned, and auctions starting to take place in late May, parts of June and July. And you see the total foreclosures again stopped in May, basically started to rebound back in June and July there for you guys. Okay. Now, looking at the nation, Alabama was one of those states that basically left it up to local levels to do something. There's currently evictions have started back up again. Foreclosures have started back up again. But for the most part, if you've got a government-backed loan or you're renting from a borrower who has a government-backed loan, you've got till the end of August, as August 31st is basically the executive order put in place by Trump across the country for government loans. Now, if you don't have a government-backed loan and you haven't gotten a forbearance agreement and you're behind, guess what? The bank's probably calling you, starting to knock on your door, trying to see what's going on, because Alabama has actually has been one of the more aggressive states in getting back to the way things were before. Now, middle of July, Alabama was up to basically 19% of what it was beforehand, which is not the highest, but is in I would say the higher tier of those those states starting to get back to auctions and foreclosures. Now, they believe, we know that the numbers rose dramatically in June. It's not looking good for parts of Alabama, for a big part of it. They say at least 33% of Alabama's adult population said they missed at least last month's rent and have little or no confidence they can pay next month's rent. Okay. They believe that at least 350,000 Alabama renters face possible evictions in the next few weeks. Okay. That's not a good thing. You got to keep in mind that. Now, is that going to lead to a lot of foreclosures? Well, it depends. As I said before, it was a government-backed loan. That's been delayed 6 months. Fannie, Freddie, FHA, they're going to end up, I guarantee, rolling back a second 6-month forbearance time frame, trying to give people an opportunity to avoid foreclosures. But it's a variety of different loans that are in default. When you look at the type of loans that are in default, it's not really your conventional loans. Those are still doing well at only a 3% default rate. It's the first-time home buyers, the FHA. Basically, 1 out of 10 FHA borrowers are in default. Now, what's an FHA borrower? That's really, I hate to say it, but kind of a subprime category. The government's put in place. Very low down payment, 3.5% down, not really truly FICO-based. But what you have had happening in the last 24 months is a lot of the banks have come in and offered up this FHA product and are donating the 3.5% down payment, and they're also paying up to $10,000 in closing costs. Bank of America has gotten very fat on these loan programs, donating the down payment and paying a big chunk of the closing costs, if not all of them. And you look in the middle there, FHA, your VA loans and the other loans are all roughly about 4.3, 4.65 in default. So your first-time home buyers, primarily in the Birmingham market, your $100,000, $150,000 and below properties are the ones that are seeing the most amount of difficulty, the most amount of foreclosures out there. Now, a lot of people say, so Scott, aren't people doing forbearance agreements? Yes, forbearance numbers skyrocketed, and they've been slowly easing back off of. The MBA says basically that we're still sitting at roughly about 4.7 million, 4.6 million forbearance agreements, but they're concerned about the roughly other 4 million other borrowers out there that should be on a forbearance agreement that have not called to negotiate with their banks to see about getting on one. Okay. Now, does all this make sense? Is it good news or bad news? Well, it depends on how you look at things. Good news, for investors, if you're looking for foreclosures, Alabama has a higher default rate than the national average, about a point higher. Okay. Obviously, a lower unemployment rate, which is good. Alabama does have a shorter foreclosure time frame when it comes to FHA foreclosures, only 420 days from start to finish on an FHA. The one kicker with Alabama is the 1-year redemption period after you foreclose, where you've got to give the borrower up to a year to come back and pay you back in a redemption period if they won't release the redemption rights. That's the one big thing about mortgages there and traditional bank foreclosures. It's kind of a struggle thing. When you add in that, plus the backlog of forbearance agreements that are sitting out there, especially in Alabama, it's going to be a while of 12 to 24 months before Alabama sees a lot of foreclosures. You're going to see later, mid to 2021, if not 2022, where you see the foreclosures hitting for the most part. Now, by that point, the banks may have moved a lot of the stuff or modified the loans or done forbearance agreements or sold them off. Now, let's talk about the commercial debt. What about the commercial loans that are taking place out there? Well, we know that there are for rent signs, companies are boarded up, businesses are going out of business. They expect 52% of small businesses to fail, if not getting worse out there. I've been saying for a while that I believe the commercial markets have been overpriced. Wall Street was echoing the same thing, where they had not been buying a lot of commercial or funding a lot of commercial deals because they believe a lot of stuff was overpriced. Now, looking at the number of defaults out there, you can see that they're probably right about that. When you look at hotels and motels is the biggest asset class, that's no surprise. That's in default, 27%, 28% through June of all loans on lodging, hotels, motels was in default. Retail was also struggling. Restaurants are also struggling. So it's really a rough time for Q2 when it comes to a lot of the commercial properties out there. Now, it's not just the big guys. It's just not the CMBS guys, although they do have a tremendous amount of debt on the bigger commercial mortgage-backed security companies out there. I mean, they lost $50 billion in value roughly in the middle of March. Okay. Now, looking at the commercial space out there, and some of the default numbers aren't surprising there. Basically, 1 in 4 hotel loans is in default. In some cases, it's 50% of hotels in an area are in default, especially the more touristy areas. You look at retail loans, 1 in 5, 20% are in default. Okay. You expect restaurant and retail space to have a higher vacancy of at least 15% by year end, if not higher. Okay. Office vacancy is set to increase to close to 20% by year end. And then the rents are also expected to fall across the board by 10.5 to 15% before 2021 arrives. And then you add in that they expect us to see a decline of an additional 5% in 2021. So you have rents going down, you have vacancy going up. Ouch. Okay. Now let's talk about who's to blame. Nobody's really to blame. CMBS guys have been financing stuff. When you look back 10, 12 years ago, they financed basically 66, 67% of what went bad 10 years ago. Well, this time around, it's a different story. The traditional banks have gotten into the ball game a lot more, where the bigger banks, or even your local banks, have financed over 53% of the distressed stuff that's on the books right now. They are the ones that finance this stuff because they got greedy. Oh, they wanted to jump in that game. Oh, commercial space. Yeah, sure. Let's go ahead and finance all this stuff at the peak of the market. That makes a lot of sense. Okay. Now, the thing to keep in mind when it comes to the bank's aspect of things is there's a lot of stuff clogging up the bank's books. Now, the banks don't finance at 90, 95% on commercial debt. What they do finance is roughly between 60 and 70% of the value at that point. When they take a look at the cap rates, the cash flow, all that stuff, they usually will finance somewhere in that mid-60s. Now, rarely does this already happen. Rarely does the bank's numbers actually happen and they come in. Usually it's below that, what the bank has done in their due diligence. We know because of just tenants and all that operation stuff. But what do you have happening now, though? If you have rents being reduced, tenants leaving, values dropping, the banks are no longer in at 70 cents of the dollar. They're now closer to 75, 80, 85% of LTV. Now they're over that comfortable mark of 69% or whatever that might be for that asset class. Now, what do? Well, they give the borrower some time. They kick the can down a little bit. But now they're going to be going to the borrower and say, listen, you're above our threshold of 65% or 69, whatever it might be. We need you to bring 5, 10, whatever amount to the table and pay down your loan to get you back to that 69% or whatever it might be. Well, do people have a lot of savings, investors, especially if they've had no tenants paying or reduced tenants? No, they're not usually going to have a lot of capital in the sidelines. So that leads to a lot of defaults. Now, will banks pretend and extend for a while? Yes, they'll pretend and extend for a while. But they can't do that on this huge amount of stuff that's clogging their books. I mean, it's clogging up their hearts faster than my grandmother's chicken will do, okay? Her fried chicken will really greasy, okay? Clogging artery real fast. But that means there's opportunities for us, okay, to be coming in, talking to these banks, and literally bringing in capital, buy some of these non-performing notes, and then reposition the asset or working out some of the loans to keep the borrowers in place or try to work with them on a stair-step basis or something to make it happen. Now, what you are seeing right now is that the banks are expecting to lose roughly $48 billion on commercial real estate. That's just what on the beginning. That's what the early part of July. I think that number is going to be a lot worse. I think you're going to see closer to $60 billion as long as a big chunk of the country keeps being closed or he's being delayed. Who knows? All right. Now, if you look at the 4 biggest banks out there, Bank of America, Wells Fargo, Chase City, they've all got a bigger piece of the pie than what they're struggling with. Bank of America set aside just recently $5.1 billion because that's what they're expecting to lose on some bad loans out there. Now, looking at what the big 4 have modified or delayed, it has been an interesting time the last few weeks, okay? Now, they have to disclose all this stuff to the FDIC when they're sending in their quarterly reports, right? America's 4 largest banks report at least $151 billion in loans with payments in deferral at mid-year, okay? That's why I think it's going to be a whole lot worse. Not that all 151 billion of it, but I think the 48 billion is being really conservative because you know they don't want to come out and tell you exactly what they accept, but they know they've got to say something, okay? When you look at what they've done, B of A, JP Morgan, Chase City, Wells Fargo set aside more than 32 billion for loan losses in the second quarter alone, okay? Look, when you start breaking it down, you can see that Wells Fargo's got basically 12% of their first mortgages in default, 10% on their second mortgages, 9% of JP Morgan's residential real estate portfolio was subject to payment deferrals. Ouch, okay? Quarters represent 3/4 of the total 28.3 billion of consumer loans in default. That's $21 billion with JP Morgan Chase alone there, everybody. Looking at Wells Fargo, 44.2 billion consumer loans. You look at Citigroup, 20 billion in consumer loans globally. B of A deferring 7.7 commercial loans and 28.5 billion in consumer and small business debt. The United States is on sale, everybody, whether you believe it or not. You may not be thinking about this, but in a time like this, yes, the banks have had some time. They've had 6 months to look at things, and they see what's going on. So where is the opportunity at? Where are the opportunities, you're asking me? And is it in the foreclosure REO market? No, not really. You're going to have to wait around 12 to 24 months to really start seeing that stuff. And by that time, who knows what's going to happen to the market? Fix and flips? No, I would not want to be in the fix and flip market. I'm getting a lot of phone calls from hard money lenders, mezzanine lenders who are pulling their capital back or tightening up their lending platforms because they see the opportunity in buying a lot of the debt. Rentals? No, I don't think I want to be in the rental market either. Okay? Now, the opportunity really does lie in buying the debt and becoming the bank in the debt game. We're going to see a lot of residential notes on single family residential properties hitting the market in the fourth quarter. Why is that? Because banks will have 6 months to evaluate their portfolio. They can see who's on the naughty, who's on the nice list. They're going to keep the nice list and look to move those off the naughty list. Okay. In the commercial space, we're already starting to see more deals now than we have ever seen over the last 24 to 36 months. Okay. A lot of stuff is hitting the books this quarter. All my Wall Street guys are like, man, I'm seeing more stuff than I can even think about. Okay. It's just crazy. And a lot of the bigger guys that have been expecting this have been pulling their capital back, expecting to dive in now, if not into the next 6 months, to really, really make a lot of money and take over a lot of wealth. As my buddies are telling me, and I agree with them, the biggest opportunity for local real estate investors in the commercial asset space under $2.5 million in value. Why under 2.5 million? Because the 5 million and above are really going to get gobbled up by a lot of the by a lot of the CMBS guys. The Wall Street guys are going to deal with that. It's not really worth their time to spend anything less than 5 million. They occasionally will, but that sub 5 million, especially 2.5 million in value, is where all the banks, local banks and other banks have gotten involved with in doing that. And the opportunity is buy it cheap, buy that debt cheap, you become the bank, and then working it out with the tenants or the borrowers on that, or taking the asset over. Or pivoting the asset, just like this guy did in Illinois. He took his hotel, pivoted into apartments and sold it off. Our buddy Garrison Gilbert is doing this on smaller ones, 40, 55 unit hotels in Pennsylvania and Maryland, doing the same, turning them into 2-bedroom apartments as he's out looking around for them. You could also be like, office space obviously has been hit hard. Hey, we got a buddy in Colorado who's took 110 unit executive office space, turned it into self-storage, got it fully booked out because the fact is it was going to sit vacant forever, and might as well make something and give those that are leaving the offices of downtown someplace to store their stuff for a while. Okay. Now, are there banks in trouble? We all know that there are banks in trouble besides just the big four. Okay. There are a lot of banks out there, and they're filing their quarterly reports and really kind of opening the kimono to tell you where to look and what they've got that's in trouble. Eventually, it's the bank's not asking you if you can buy, but to buy the whole thing, but to buy something is what we're going to see. Okay. Now, looking, there's a agency called Bauer Financial that evaluates the banks. They look at the quarterly reports, and then they publicize those a report that you can pick up every quarter. And we just bought something we track every quarter. June was the most recent one. We just purchased their quarterly report. And we like to look at any bank that has over 5 branches. Okay, 5 branches or bigger. That gives them a little bit more of a footprint. There's a lot of one single branches that are way too conservative on their loans. We don't really want to waste your time on. We'd rather, fish in some bigger pools. So when you look at that, there's basically 1,574 banks that have at least 5 branches or more. When you narrow it down by those that have that are based in a specific state, Alabama, while we know there's thousands of banks lending in Alabama, there's no doubt to that, there are 46 based in Alabama that have 5 or more plus branches. Okay. Now we know there's more that are based there. What I'm saying is these are the 5 that have vital offices. They're lending in Alabama or other places as well, but their main corporate office is in Alabama. Now, out of these 46, they have a combined $1.9 billion in 90 plus day defaults. And an additional, this is the scary stuff, what's coming down the pipeline, another $900 million in loans that are 30 to 89 day lates right now. That some of those are already moving into the 1.9 billion. When quarterly reports come out, you're going to see 2 billion plus from those 46 banks. An average of 4.29% of each bank's loans on an average basis is in default. That's 90 days or greater. Out of that, basically 1.9 billion, a quarter of it, which is what we normally see. It's been kind of interesting to see that 75% has been on the commercial side and roughly about 25% on the residential side. 502 million in single family residential loans at default. This is why I think the commercial side's be a lot worse than what they're saying on the residential side out there. And the biggest contributor is Regions Bank. We've bought debt from Regions Bank, done it quite a bit. They have over $851 million in 90 plus day defaults. I think they average roughly about 11% of their portfolio is in default across the board. And then if you also look at BBVA USA, that's used to be BBVA Compass, they've got an additional 739 million in 90 plus day defaults. Okay. And both of those banks will sell you commercial loans all day long if you know how to get to the right department. How do I know this? Because I've bought from both of them. Okay. I've been to the headquarters for both of these in Alabama before. I've been and visited with the bank's special assets managers, secondary marketing professionals, and I know that they'll sell. They're looking to move stuff off their books because they can take the capital in. And yes, they'd be willing to sell commercial debt at a discount now so they can get that cash in to offset other bigger losses. All right. When I saw those names, when I was doing the research for this, I started to salivate, ladies and gentlemen. I'm not going to lie to you. I started salivating. Okay. So why should you buy distressed debt? Why should this be an investment for you or look at it as an investment? Because of a couple things. One, the opportunity right now, you can start buying debt currently versus waiting around for those foreclosure auctions that may never show up. All right. Now, that's not saying you're not going to see other foreclosures along the way. I get that. But the huge amount of debt out there, that's the time to act, to buy in, become the bank, and then you hold all the keys to the castle, the keys to the Ferrari, and how to modify that or work with the borrowers out there. You can buy this debt at significant discounts depending on the location, the foreclosure timeframes, what goes on with that state, the values, the condition, the asset class. All right. I'm seeing banks selling hotel debt roughly at about 20 to 25 cents on the dollar right now. Yeah, some opportunities there. Okay. You can purchase the debt and control the asset in a variety of different ways for a huge discount, somewhere between 30 and 70% or greater off of what's owed or off the current market value. And your strategies would be to try to get the borrower to reinstate, to modify, short sale, short payoff, foreclosures, loan sale, deed and lose, cash for keys. There's a whole variety of different strategies that you can do. Okay. Now, a lot of people say, I want to take over the note and turn it into a cash flow performing note. That's a beautiful thing. It always works better. I always end up making more on your money by taking over a note and keep it and turn it into a performing note. That's a beautiful strategy. That's our favorite strategy. Okay. But if you want to take it over the note and then take over the property, okay, you can do that as well. And do what you want. Keep it, turn around and re-gentrify it, reposition it, resell it, hold on to it for a while, use it for your own self. There's a lot of things you can do on the distressed debt side. Now, some of the other advantages of note investing and buying debt versus the other stuff is the first thing a lot of investors, that when they get into the notes, into the real estate space, they're sending out postcards and yellow letters and trying to find deal flow, which I found extremely inefficient. I did that for years. From 2002 to roughly 2008, I did a lot of that. Okay. And I found out it just didn't make a lot of sense because it was such a low response rate, thousands of dollars out for a 1 to 2 to 3 to 4% response rate. And then I had to go back and do it every month over and over again. Well, in the note space, we don't do that. We don't mail postcards, yellow letters, bandit signs, go knock on doors. What we do is if you've got the ability to jump on your computer and send an email, reach out on LinkedIn, or pick up the phone and dial for dollars, you can do this business from anywhere, ladies and gentlemen. You don't have to have huge amounts of money to do that because the banks, are going to give you some pretty good deals, what's going on, that you can raise some capital for these things, okay? And the gorgeous thing is that you don't have to be compelled for that one deal. One source, like Regions Bank, led to hundreds of deals I could take a look at. It wasn't, I got to send out postcards to get one deal, hopefully from this borrower, and then replicate all over again. No, once you're in, okay? You get a list sent once a month, once a quarter, lots of real deal flow from making that one contact at the bank. It's just about getting to the right person in the bank, okay? And if they send you stuff, great. Cherry pick the best deals for your portfolio that you want to keep. You don't have to buy everything, okay? There's stuff on it that they're trying to sell this month that doesn't make sense. Hey, wait till next month. Or if there is something that you like and they don't agree with it, follow up next month, see if they sell. Because a lot of times, especially as we get closer to the end of the year, everybody, the banks will be a lot more willing to make some discounts to get some stuff off their books. If you can buy in bulk, you can get better pricing, but you're not forced to do that. Unless, of course, you're trying to buy residential loans from the bigger banks. Bank of America, Chase, they're going to want you to buy a $50 million portfolio. It's not worth it. There's a lot better deals out there. And you can do it, like I said, residential commercial deals. There's plenty of other banks out there that have debt on the books they're looking to get rid of. Now, if you don't have capital of your own, don't worry about it. There's plenty of investors out there that have money literally sitting on the sidelines wanting to invest and getting some good deals out there. Now, think about this, ladies and gentlemen. If there were 15 million homeowners underwater at the peak last time this happened in 2010, and they're forecasting that, the question I want to ask is, how big of that piece of pie do you want? If you could go back in time 10 years and do things differently, what would you do? I know I'd buy a whole lot more. I know that I would market the heck out of it. I would talk to more investors to raise more capital to take down more deals. And the thing is, history is repeating itself, ladies and gentlemen. That's why I'm so passionate about this being the opportunity that really only comes around once every 20, 30, 40 years for us. Yes, I'm lucky enough to have it twice in 20 years. Good stuff for me. Can be good stuff for you guys out there as well. And now, are there investors out there to fund your deals? Heck yeah, there is $9 trillion in retirement funds sitting out there waiting for you to reach out to them. $9 trillion, making less than like 1% for the most part. Now, if you want to just narrow it down to the Birmingham market, Birmingham's got quite a few investors as well. We're able to track this. Birmingham itself has 12,000 investors with an IRA in the area. Got to have some sort of IRA, individual retirement. There's 12,000 there. I know that's going to shock some of you out there. Now, out of that 12, roughly 8,000, 2/3 of them have at least 150 grand or more in their accounts. What? Yeah, how many people do you need to talk to put together $1 million or more? Not too many, if you got what you're talking about. Now let's say this. Oh, Scott, I'm scared to talk about money. Oh, I don't want to raise capital. I just want to flip deals. Well, guess what? That's fine. There are literally 14,000 investors just alone in the Birmingham market looking for deals. So go find the deals from the bank and then flip them to other local investors. Go out and flip. That's just in Birmingham. If you're finding investors in other areas, there's more investors in other parts of the country. But the beautiful thing, everybody, if you don't want to take the deal down yourself, flip it, wholesale it, assign the contract, make your wholesale fee, and move on to the next deal. The banks don't give a rat's ass who's funding the deal. They just want money to come in so they can get the assets off their books, okay? And the question I always want to ask everybody here is, do you want to be the banker or the borrower? You don't want to be the borrower because you're paying money out every month. And we're all in the note space already, whether you're watching this live or catching this on the replay, you're in the note business. You're just on the wrong side of the payment stream. You want to be on the bank side because, ladies and gentlemen, there's so much literally savings sitting out there right now. We have more savings sitting in accounts out there waiting for something. You know what the bank is doing with that money? They're leveraging it out. Yeah, they're paying you 0.1%. They're leveraging it out at 6 to 12 to 20 and making huge returns. You can do the same thing in the note business. Cheap money in and making great returns by buying assets at 50 cents or less on the dollar, or a number that makes sense to see above average returns. Because everybody, here's one thing, if you didn't know this already, the bank always wins. That's why the bank is the biggest companies out there. That's why the banks, they're not in the rental market. They're not in the Airbnb, the fix and flip market. The banks are in the note space. And that's why they win. There are plenty of investors out there to fund your deals, plenty of investors out there to flip the deals too. So it's up to you whether you want to be a deal engineer or take them down the deals yourselves. Okay. So how do you tap in the tsunami, ladies and gentlemen? Well, you got to do some things. Okay. I've been teaching real estate investors about notes, especially non-performing notes, since 2010. That's why I'm called the note guy. Okay. I've helped thousands and thousands of investors purchase their first non-performing note, their performing notes, done on both residential and commercial deals all across the country. All right. Whether people are looking for cash flow, passive or aggressive, or they're looking for asset growth. They're looking for more properties to add to their portfolio. There's nothing wrong with either one of those. And in this time frame, you want to be looking for both. I know I am. Okay. Now the thing you can do is you can buy one-offs or you can buy in bulk. Okay. We've done trades from as little as 25 grand all the way up to 5 million and beyond. All right. The cheapest note I bought was for $7. Flipped it for 5 grand the next day. Okay. Biggest trade I did, $5 million, was on 3 condos in San Diego. Biggest asset trade I did was at 1.2 million for 175 notes across the country. You don't have to worry about funding $1 million right off the bat. There are plenty of deals out there, no matter where your strength is, where your experience level is, everybody. And I don't care. The bank does not care. Nobody gives a rat's ass about whether you got a 500 FICO or an 800 FICO. The bank doesn't care. Can you fund? Do you have money that will come in on a specific day after you do your due diligence and everything checks out and we agree on a price? Can you fund? That's all they give a rat's ass about, okay? And you can start doing deals, like I said, without having to drop thousands and thousands of postcards on emails, LinkedIn, or banks. It is a lot easier to make a lot of money in notes than it is in other places. There's some team members, there's people out there to help you in the note space, unlike other places out there. Whatever your focus is, I said before, if you like single family homes, great. If you like apartments, great. If you love hotels, motels, self-storage, retail, office, whatever your, institutional debt or in storage space, warehouse space, that's also a big product out there. Mobile home parks, okay? You can really start doing great deals today in all asset classes and really creating win-win scenarios for you. Wins, I'll give you an example. Plenty of Americans are hurting. Salt of the earth people. They lived in their houses for a year. They want to stay in their house. If you come in and pick up buy the notes at a discount, you have the flexibility to modify their loan to keep them in their house to do a lot of good. And I do find that a lot of people want to stay in their house if they can. They want to be good Americans. You do have those that will take, if you give them an inch, they'll take a mile that you've got to foreclose. But by golly, Miss Molly, there's a lot of things you can do to help a lot of great people out there. Maybe you want to go high-end stuff. Hey, we see a lot of distressed debt on the high-end side of things. That's where really peak in foreclosures are happening. That's a jumbo loan aspect of things. Or, hey, if you're looking for multi-assets and want to take some apartments, you're going to see a lot of distressed debt, especially in a 100 unit or less, or around college housing. A lot of apartments in college cities are struggling because people aren't showing up to go to school. So you have some opportunities there for everybody. Now, you can do this big, you can do it small. I always tell people, hey, start off small. Let's get your systems rocking and rolling, okay? And we've been very successful at helping a ton of investors do stuff. Just like Gene here. Gene started off very small out of Elkhart, Indiana. When we met him, he had bought one or two assets, but really hadn't tapped into what's going on. We spent some time when we trained him. We show him how we contact banks. We showed him what to say, what not to say. Boom, fast forward about 4 or 5 years later, actually 4 years now, he's closed on over 135 assets. He's actually was scared to raise private capital when we first met him. He's gotten beyond that. He's raised over $13 million in private capital. He's got his own fund and doing an amazing job in what he would call retirement. Does not expect to retire. He loves what he does. And it's added, retirement has a little different definition when you're making 7 figures. So kudos to Gene out there. We're excited what he's doing. Then you've got like Laura Blunk here. Laura Blunk just moved from South Austin to Maryland. When we met her, she was like many real estate investors. You're going to your local real estate club. You're trying to learn the different strategies that work in your market or don't work. Wholesaling, doing some light rehab, subject to deals, trying to make it work. Austin's a competitive market. She met us, learned the note business from us, closed on 15 deals in her first 14, 15 months. Fast forward another 2 years now, she's closed on over 100 assets and is getting ready to close on a portfolio of over 100 notes that she's buying at 50 cents of value or less. And guess what, everybody? These are performing notes. It's a great deal. An investor, a fund is trying to get rid of their portfolio to cash in, and she's found an amazing deal, $4 million purchase price that she's going to fund with other people's money. So proud of what Laura's doing. Just absolutely changing her destiny completely. You look at Keith Collins. Keith's got a lot of real estate experience before we met him a couple years back. Worked in city governments, built and created water treatment plants. I think he was the mayor of a small Ohio town at one point. Learned the note business from us. Met him about 3 years ago. He sent me an email just recently. He says, Scott, it's amazing what we've learned from you. With what you have taught us, he's made over 7 figures in the last 12 months. He's looking forward to what's going on right now and doing some amazing things. Now, all these people, great experience, got some good experience to understand things, but you don't have to be experienced in real estate to dive into the business. There's our people out there, oh, the bank won't sell to you because you're too small. That's a bunch of big bullshit. The banks will sell to you. There's plenty of lenders out there that have stuff on their books that we can get rid of. Don't care. If you can fund and you get rocking and rolling, guess what? You can do this. Just like our buddy Raphael here, a student of ours, no real estate experience. He owned a small business, a car detail business in San Diego, 15 full-time employees, completely shut down with COVID. Had to lay everybody off. Doesn't think he'll reopen. Things could be really, really bad for him because nobody wants to get their car detailed when they're sitting at home and not driving. But luckily, Raphael started learning the note business from us, came to us November, took our training, and has done an amazing job. Bought 5 assets in his first 60 days. First 2, he got reperforming at roughly about 20%. The other second 2, he's flipping to double his money. The 5th one he's still working on. And he's just so excited because he's also, while he funded the first couple of deals with his own money, he's raised about 100 to 150 grand in private capital from his friends and families around him in San Diego to go do some bigger things. And he's like, Scott, I love what I learned. I'm not so stressed about what the future holds for me because I know with what's going on in the market, there's a lot of opportunities to tap into. And like, he's just like so many other investors that we have helped with no experience or some experience doing some amazing things in the note space, helping not only themselves, but helping thousands of borrowers out there stay in their house, stay in their business by really helping them by buying the debt and working out with them. And we couldn't be more proud of our students. It's one of the things we get so excited about is seeing all the deals that our students are closing on. And we've really helped change do a lot of good out there. How'd they learn? They learned by coming to our note note training. We have a one-day workshop called Note Weekend. Basically come in and spend an all-day Saturday with yours truly, teaching you the nuts and bolts and the basics of the note business. You're not going to learn everything about distressed debt in one day, let alone 3 days, but you can get a good foundation and a good start, get rocking and rolling. And the biggest mistake that we see is investors that think they know everything, but they don't understand that notes and distressed debt is completely different than going about buying a property or buying a rental, okay? And so that we call this, it's a, like I said, it's a one-day note training, mini workshop. Yours truly, it's all day Saturday, okay? Our students call it the Cliff Notes of Note Investing because we really do cover a lot of great things, therefore, to give you a great foothold on the note business to get started. All day Saturday with me, we restream it, rebroadcast the replays on Saturday, on Sunday for you. The replays are included, so if you got to step away for a bit, don't worry, you're not going to miss anything. It included a 20-page manual as well, along with it, and then about another 10 hours of video training from other replays that we use with our vendors and other things for you. Normally it's $97. We usually run from 9 to 5. Sometimes we'll end a little bit early. Sometimes we'll run later than that. Totally fine. I'm here at the very end. We take a couple breaks, but most of the time it's me going through step by step our manual to show you the basics of note investing. And we host this at least once a month, usually the third or fourth Saturday. We've got one coming up very soon that we'd love for you guys to be a part of. Remember, we mentioned early on, love to help 1,000 investors tap into the note space. This is how we're doing it. We're making something that's affordable for everybody's budget to tap into, learn the note business, and go out and take advantage of things. Now, what do we cover? If you go to noteweekend.com and scroll down a little bit, you can see the full schedule of the whole day, kind of the tentative timeline. We cover a lot. I'll tell you that. I cover a lot. I'm hoarse and usually can't talk by the end of the day. So the first part of the day, we talk about how and where to find the note deals, how to talk to the banks, what to say, what not to say, whether it's on the phone, via email, or via LinkedIn. We'll talk about where to and how to fund these deals, how to find investors around you that you can tap into and talk to about raising capital, finding investors who are ready to pull the trigger now. We'll talk about the different exit strategies. There's multiple ways to make money in notes. As we talk about find, the fund, and the flip, the 3 F's of note investing right there. You don't have to take the asset down, but if you do, you'll make a lot more money than just flipping it, okay? We also talk about the different vendors and the teams that's there to support you, the servicing companies, the real estate attorneys to help you with the foreclosures or the loan modifications, how to get realtors to pull values for you, how to identify you've got a deal and not a dud. That's an important thing for all of you. We'll also talk about the different loan trading platforms. Unfortunately, there's not like an MLS out there with distressed notes, but there are some websites out there that have commercial and residential notes that you can start looking at right now. You don't have to wait till they hit a foreclosure auction. You don't have to wait. You can actually start looking at assets the day of the class if you need to. And we'll cover a lot more marketing, other things. Like I said, you can't learn everything about the note business in a day, but we sure as heck try to fill it up with a whole lot of stuff for you. Never had anybody complain about the class. They're like, oh my gosh, this was one of the best things when it came to note investing. There are a lot of educators out there that talk way above people. I'm just a normal guy. So I can teach you what I've learned over my 12 years of experience and thousands of deals out there for you. You can go to noteweekend.com and get registered today. That's noteweekend.com. And if that's not enough for you, what we're going to cover, you know what? Let's throw in some bonuses for you. How's that sound? I think everybody loves bonuses. And these are things designed to help you take your business to that next step, ladies and gentlemen. Obviously, you got the class, okay, the one-day note training weekend. We also have a very special thing that we do once every 2 months. Once a quarter, but we've got an upcoming, not this coming Saturday, but the Wednesday after the class is our Calling Banks training. This is a 4-hour, 5-hour training where yours truly, me, you can watch me call banks. You can see me dialing for dollars. You can see who I'm calling. You can see what I'm saying. You can hear the conversations back and forth with me and the asset managers, and people love this, okay? Usually I have about 100 or 200 people watching me do this. It's a great training thing. It's recorded. Boom, that's normally $49 to $59, depending on when we're doing it. That's included for you, right? We throw in the Bauer Financial List that lists 1,700 plus banks with 5 more branches that tells you exactly how much in distressed debt they have, how much in potential distressed debt, residential, commercial, great list. This would cost you roughly about $400 to $500 to buy it every quarter. We throw that in the most recent one. I'm going to do a 30-minute phone call with you one-on-one after the class. I charge $1,000 an hour for consulting. I want to spend time with you to go through where you're at, what you're thinking, and which direction you want to go in the note business for you. So that we throw that in there for you. Also, guys, the replays are included. If you want to have your spouse or business partner attend, just let me know. We'll let them attend at no additional cost. That's at least $97 there for you. And then we also have an amazing Facebook group and a network of 900 plus students that are part of the group. That is a great way for you to ask questions, a great way for you to network with other note investors as you have deals or as you are looking for funding or other questions out there. Boom, Great group out there. Love those students. It's one of the great things about this. All that included, guys, is over $1,000 in bonuses. All that, and we're going to do something very special for you. You're going to drop the price from $99 basically down to $49. So you get all those things for just $49. And we'll throw in one other thing. Somebody asked me this the other night. Well, what if I take it and I don't want to do this? We'll refund your money back. If you find yourself on our Note Weekend training, like, this seems too complicated, I'm too busy, I got too much stuff going on, let us know. Boom, we'll gladly refund your money back and let you go your merry way. I don't want to take your money if you're not going to take action on that stuff. And I understand it. Oh my God, I got too much money in my books. Okay, fine. Got to let me know Saturday, though. Can't go on like, no, next week. I'll get around to it. No, let me know Saturday. You got to show up, everybody. All right. That's why we at least do it at $49 instead of for free, because free has no value. So I would love for you guys that are watching this to be a part of it. We're here to help you. If you get signed up today, I can get you a link to the last time we did the class as well, so you can start watching that so you're more familiar this next time that we do it. And it's a beautiful, beautiful thing in the note business, everybody. Great way, great business to be in if you know what the heck you're doing. Now, if you don't know what the heck you're doing, you can really get in a lot of trouble if you're evaluating things incorrectly. So like I said, love for you to be a part of it. Noteweekend.com, whatever your goal is. We talked about this before, whether it's to retire yourself, to spend more time with your spouse, to pay for your kids' school, to send them to college, to retire your parents. Maybe it's just to travel more and do some cool things, because you can do this business from anywhere. I've modified loans or negotiated deals in the middle of the ocean, in Europe, on vacation. I get an email or a Facebook message from my team. Here's what we got situation. Can we get your approval on it or decline? And it's a beautiful, beautiful thing. You don't have to do all the work yourself, ladies and gentlemen. So maybe if you're even wanting to upgrade your digs, your house, your tools, whatever it might be, we all know it takes money. And why not deal with other people's money? Because the bank always wins, ladies and gentlemen. So love for you to be a part of it. Noteweekend.com. Go there, click on it, take you directly to the website. Click on the RSVP your spot. Get signed up today. Pay your $49, and we'll see you Saturday. If there's any questions online, real fast there. Anybody got any questions? If not, great. We'll see you guys Saturday. Noteweekend.com. Get signed up tonight, everybody. We'll see you all at the top. Thanks for being on tonight.